All right, good evening, everybody. Welcome to Using Time Spreads, How to Trade Calendars, Understanding Option Structure, the Option Pit Method. I am Mark Sebastian, the founder of OptionPit.com and Chief Investment Officer of Carmen Line Capital. So, let's talk about me, my favorite subject. That's me, about 5 foot nothing, 100 nothing. But one thing I really do know is options. And on this in particular hit, I was talking about how to use stop orders and how kind of options can replace stop orders. I was a floor trader for about a decade, a little less than a decade. And since then, I've been doing a combination of off-floor trading and consulting and education. All right, Option Pit is an education and consulting business. We work with retail traders to help them understand how professionals trade and to manage risk like a professional. And we work with with money management firms, things like that, to help them stress test their option systems, things like that. I like to joke that we have helped clients with as little as 1,500 and clients with as much as 15 billion. And the scary thing is the client with 1,500 usually knows more about options. So let's talk about what we're going to learn. We're going to find out what is a calendar spread. Trades a calendar shares similarities to. All right. How the calendar can tell market sentiment. All right. What makes a good time spread? All right. Using term structure to your advantage and choosing the right calendar. A calendar is the buying of one option against the selling of another option. Plain and simple. And I'll just end the webinar right there. Just kidding. But the nice thing is we're going to do 45 minutes of real good education, then I'll take 10 minutes for questions. So a calendar is essentially a volatility swap. It buys premium in a contract that is, in relative terms, cheap to the option being sold. Or, if you like it the other way, one can say it sells premium in an option that is, in relative terms, expensive to the option being bought. Really, these two sentences say the exact same thing. You're buying something that is cheap relative to something being sold, or you're selling something that is expensive relative to what's being bought. So that's a relatively benign. They're basically saying the same thing. I guess the only differences in these statements is where the initial idea generation comes from. So the idea generation may come from the sell side. Maybe you would look at this sentence. If it's coming from the buy side, maybe it's coming from this sentence. But really, it doesn't matter what you think you're doing. You are selling one contract and buying another and thinking that there's a misplace in price. Right? Terms can be bought or sold or traded across multiple terms and strikes. There are double calendars, triple calendars. There are offsetting calendars. I've seen calendars where somebody buys a butterfly in one month and sells a butterfly in another month. So they've been done in terms of like variance swaps, where a trader sells all sorts of contracts in one month and buys them in another. Calendars can be done in future spreads as well. In that case, you're usually doing things like trying to sell one contract in soy against soy meal or soybean oil. So there are all sorts of types of calendars, but the ones we're talking about are option calendars. And the key to these is premium. I want you to think about the premium you're collecting. I want you to think about the premium you're paying for when you set these up. You figure out what is a good premium price on all of your calendars. So, yeah, that is in fact a calendar. So it really doesn't matter what the duration is. So a long calendar sells a near-term contract, and a long calendar buys a longer-term contract. It is a net debit. It is a net debit. If you are putting on a contract and it is a long calendar and it is a net credit, do not think you are getting a free lunch. Something is probably wrong. In my opinion, there are very few times where buying a calendar for a credit works in one's favor. That is a losing proposition. All right. So the product produces a trade that is hoping the underlying doesn't move much, but the perception of movement will increase. So let's think about that. You're selling something because you don't think it's going to move during that time period, and you're buying something behind it, hoping that perception is it will move. So this is called being short gamma and long vega in Greek terms. Short gamma, long vega. You are short exposure to movement, and you are long exposure to implied volatility. So here is our calendar spread. All right, and you can see I took this from today, right around, probably 1:45 Central Time, right before the market absolutely took off. And what I want you to notice is check out this minus 10% and plus 10%. Those represent a 10% increase or a 10% decrease in implied volatility. So let's look at what might have happened. As you can see, take a look at kind of 21.13, so up 2%. With the market unchanged, or with implied volatility unchanged, this position loses about $236. With implied volatility in 10%, look how much you lose. You lose $500. With implied volatility up 10%, instead of losing money, you make money. How your position moves is relative to this vega number. You see this where it says vega? This calendar has 162 vega. And what that means is if implied volatility, if all else being equal, what that means is all else being equal, if implied volatility increases by 1 point, 1%, my position will make $162. So with the VIX at 15, if the VIX goes to 16 and the S&P doesn't move, I will make $162. All right, this is how this calendar is structured. So those are really the basics. Now, let's talk about what this structure really looks at. I want you to take a snapshot in your mind of this structure. And I'm going to show you something. Does this structure look pretty similar to this structure? Take a look again. Does this structure look like this structure? Just look at the risk shape. Fundamentally, yes. Fundamentally, yes. That's the perfect answer. So one of the things that I think traders would be surprised by is that traders are willing to trade calendars all the time. They might be less aggressive if they knew how similar the risk profile was to a trade another trade that traders seem to like, but most retail traders are terrified of. And that is the straddle. This is a short straddle at the 2075 strike. So traders are terrified of straddles, and yet they're happy to throw on calendars. And really, the risk profile is very similar. A long calendar is really just a short straddle that has a hedge on. Whereas a short straddle has quote-unquote limitless risk, a long calendar is limited to the cost of the spread. That said, around the money, the two can behave very, very similarly. All right, extremely similarly. So the risk profile near the money is similar. So a short straddle, you need a lot of cash, don't you? On a PM account, it's not that bad. But but one thing people don't realize is really the risks are similar. It's not hard in a small market move to lose similar amounts of money. So just be aware, when you trade a long calendar, you're not getting long market exposure to volatility. You are short movement. You are long the perception of movement. You are selling movement. So when I buy a calendar, I don't want the underlying to move very much. And truthfully, I'd rather volatility be stable than volatility go up. All right, the differences. The major difference is the vega. Because a calendar is long vega, it will provide a cushion on a sell-off, a small cushion. However, if the underlying rallies, a calendar has potential to drastically underperform a short straddle. Understanding how the risks affect the different parts of the time spread is key to managing the risk. So as this sucker moves around on a rally, so if we think about it, on a 2% rally, you're more likely to end up with this 506 number. And on a 2% drop, you're more likely to end up with this $60 number. Whereas a short straddle, kind of the opposite. On a 2% drop, you're likely to end up with this negative 839 number. And on that 2% rally, well, it doesn't look that great either. You're likely to lose that 844 number. All right, and we're going to talk about a little more about how to manage these and how they're interrelated. But I want to kind of go through the short time spread first. The short time spread buys the near-term month and sells the long-term month. The trader is buying movement and selling the belief that future movement will persist. The trade is long gamma and short vega in Greek terms. The trade is very similar to a long straddle. So here's that long straddle. Take a look how the movement is affected. And then here's your short calendar. See how similar they kind of look? Notice they both want the underlying to move. They both want the underlying to move. But a short calendar does much better on rallies than oh, okay, I understand. However, a long straddle, fixing this on the fly, folks. A long straddle does much better on rallies than a short calendar. Right, that's just wrong. All right, a short calendar, I don't know how that got in, does much better on rallies than a long straddle. Sorry, folks. All right, a long straddle crushes it on sell-offs, crushes the short calendar. Again, understand the risk characteristics of both, all right, is important. Understand that you want the underlying to move. That is the key. Movement is the key. All right, questions on kind of basic structures of these two. Laughing out loud if you had a couple. I wish. I'm actually on vacation, but I've not been imbibing, unfortunately. What kind of permission is necessary to short a long-term leg? It seems to me they wouldn't be too keen to uncover position. You just need portfolio margin. In addition, you could use span margining from futures options. All right, that is the key. So in all time frames, yes. All right, and of course they jack up the rates if you don't roll your coverage back. And there are alternative ways to set these things up, but the easy way is to be long front and short back in like an S&P futures options. So S&P futures options are relatively, okay, these aren't done without some sort of leverage or protection then. So how do you defend a calendar trade? We're going to talk about that a little bit. My goal here today is to get you into good trades. If you get into good trades, you do a lot less defending. Term structure. One of the keys to understanding calendars is to understand term structure. Term structure is how volatility is spaced across different months. All right, one can visualize it simply in the VIX futures. VIX futures bear a very close resemblance to the contracts months of the SPX. So let's take a look. This is from VIXCentral.com. This is a great website. If you're a VIX futures trader, if you have any interest in VIX, this is where you are going to make your money. So you can see the VIX cash kind of represents the August contract, the 1640 September, and you can see how the whole curve looks. This curve is going to be the key to how you make money trading this stuff. Now here is the SPX itself. And this is kind of indicative of the risk profile we've been seeing over the last few days. And this is taken from today. Notice, it's always kind of worth it to discount the weekly contract in terms of a real look at term structure. You can even discount week 2 sometimes. Really anything with less than 10 days to go. But if you look at kind of the total term structure, July versus August versus August versus August, you can see that basic term structure goes from kind of V-shape, kind of easing from higher to lower, and then back higher in the shape of a U. SPX has a huge bid-ask spread, but so the question is, well, SPX has a huge bid-ask spread. Yes, but it also is the most liquid option contract in the world, and those volatilities are locked down perfect almost all the time. And the inside market on those wide bid-ask spreads is usually somewhere between 20 and 30 cents, which if you look at SPY is 2 and 3 cents. So, just you should be able to see kind of how the term structure moves. So notice you get kind of this type of shape. It's kind of lower, bottoming, and then starting to increase again. Which shows you where perceived risk really is. All right, people do not seem to be that worried about this time frame, but they don't like what they're seeing here. I actually think this represents a really good opportunity in a calendar spread. And don't worry, at the end, I'm going to go through kind of the checklist to get into calendar trading, and then maybe we'll walk through one our live environment on top of the one that I pull out. So term structure and risk. And this is one of the ways I want you to kind of start looking at term structure. When near-term structure, expiring weekly aside, is such that near-term options have lower vols than long-term options, that is a sign of a logical market, I call it. When the opposite occurs, that means the overall market is in turmoil. Where are we today? Take a look. So kind of think about when you're looking at the sloping of term structure. All right, when it's upsloping, the market is loud, and when it's downsloping, the market is quiet. And when it's kind of in the middle, the market is really unsure what's about to happen. This is a transition period that we're in right now, and it is extremely dangerous to trade in. It is not hard to lose a lot of money trading in an environment like we have today. I personally got absolutely slapped around a little bit on that reversal. That was painful. I missed dumping a little short position I had on by about 2 points. So this is kind of the way I want you to think about the overall market. All right, so now let's talk about the keys to success. From here on out, I'm going to be discussing just the long-only calendar and how to execute it, because that's what most of you are here for. And I'm here to tell you there are really two major keys and one minor key that I'm going to touch on. And if you can figure out these three keys, you can figure out how to make money in calendars. One, overall implied volatility underlying. Two, term structure. I'll get to the last key in a little bit. Those two forces produce a high or low price on a calendar. And in the end, it all comes down to price. As a calendar is long vega, the goal of the trader should be to buy the cheapest implied volatility possible. This is going to cause the overall price of the calendar spread to be low at time of purchase. So then look at where the IV is in the cycle of the current trade. All right. There are four major volatility cycles of the marketplace. Do we know when they are, what they are? What are kind of the four major cycles? Low, medium high, and high. Now here's why you're going to trade a lot more calendars than you expect. Because low and medium low probably account for 70-some-odd% of the market. All right, maybe 80. If you think about the VIX, low is going to be kind of anywhere below 14. All right. Low is going to be anywhere below 14, 14 and a half. Kind of 14 to 15 we'll call kind of the transition level. And then medium low is going to be kind of 15 to 18. So below 18 is going to represent about 80%, about 70% of the time. Medium high, which is 18 to 22, 23, that might be another 20% of the market, maybe 25%. And really, truly high implied volatility, periods where the VIX is actually shaking in its boots, probably only account for about 5 and at most 10% of the time. Now, within those cycles, I typically really only like trading calendars in cycle 1 and cycle 2, low and medium low. And then I'm looking for the lower end of those cycles, kind of the bottom 20% of volatility. So I've been loving doing calendars when the VIX has been in the 11s, 10, 12s, and 13s. I've been kind of soft on them above 14. So that's the key. Implied volatility and price. The second key is term structure. When buying a calendar, the trader should be looking for flat to positive term structure if at all possible. Or at a minimum, relatively flat to where the overall term structure has been. All right, so you want things as flat as they can be or slightly positive. Unfortunately, when implied volatility is low, often term structure is in a steep contango, except for in the very near term. Getting a positive term structure against low IV is the absolute home run, the holy grail of calendars. So if you can buy dirt cheap implied volatility in the long month and sell something that is in higher implied volatility than what you just bought in front of it, You are sitting on gold. It's gold, Jerry, gold. All right. So it's all about that term structure. All right, so why does it work? When we buy low IV options, they have the most gamma. The lower implied volatility goes, the more gamma, the more price movement you are getting, the more exposure to price movement. When we sell higher IV options, they have less gamma. So that lowers Greek risk. So if I'm buying something that has more gamma and selling something that in the front that has relatively less gamma, I'm shrinking my price movement risk on top of buying something cheap. All right. So then also when we buy low IV options, they have the best ability to benefit from an increase in implied volatility. When we sell high IV options, they are relatively insulated from an increase in implied volatility, at least in normal times. So this lowers that vega risk. So we're lowering our exposure to movement and the perception of future movement. And that is really constitutes itself in a very low priced calendar, in a cheap calendar. All right. Now, the final risk. When you say buy low IV options, do you mean in the money, at the money, or out of the money? You know what? This holds up whether you're trying to do directional calendars or non-directional calendars. All right, so actual movement is a huge risk in calendars. So one thing to look for is to make sure that realized volatility, you can look at that in 20-day HV or 30-day HV, is not going higher. All right, well, you want to look for events that might cause movement in the near term and look for events that might hold up IV in the long term. When we want IV lower than HV, but HV to be sinking. So you want HV to converge on IV. So movement should converge to IV. Basically, the movement should be done. So calendars can be placed at any different contract months. You can do weeklies, you can do monthlies, you can do long term, it doesn't matter. Find an option with the lowest IV on the board and set that as your anchor. Then find the 2 months that trade against each other best. So find a low IV for an overall option, and then find the 2 months that fit best. And then pick your strikes. For a directional calendar, make sure one is setting this up at beyond where one might think the underlying could go. All right. All right. The congestion zones, someone said you're looking for congestion zones. The only congestion zone I try to look for is the one in my septum. That's not a term I use, but I'm sure that that's probably correct. I'm looking for areas where the market's where the underlying isn't gonna move. All right. So in addition, directional calendars kind of stink for bullish trades, except for in the lowest of IV environments. It can also be great for illogical, trendy stocks. So, if you're in a stock where when the underlying rallies, the implied volatility rallies, what does that tell you about the long-term direction of the stock? Is it in a year? Is it going to in 6 months? Is it going to be higher or lower? If you buy, if when an underlying rallies, the implied volatility rallies over the next 6 months, is the underlying probably going to fall or is it probably going to rally? What do you think? Yeah, the answer is fall. That's almost always a sign that a name is topping out. So those illogical trendy stocks can be amazing long calendar plays on bullish trends. They really can. Because when they rally, they're gonna pump that long-term junk, the long-term stuff, because people think it's gonna drop. All right. So, just be aware that that's a case. So I love bearish calendars, and I like bullish calendars on trendy stocks, and I like at the money calendars. So let's go through my calendar checklist. So 1, what IV cycle are we in? 2, where is the IV in the cycle? What has the movement been like? What does the term structure look like? And then finally, if my assumption changed, I'm going to get out. Bing, bang, boom, bam, bomb. 5-point checklist. So I'm going to show you one called Ulta Cosmetics. So let's take a look at that movement. Does that look like there's a lot going on there? A little bit of a breakout today, but it looks like it's gonna, every time it gets these little breakouts, it stays in a range. In addition, the HV is sinking. Now the IV is off this really crazy low, but still, in relative terms, is about as low as the IV can get. All right, and we're in the cycle, we're in a ultra low IV, and within the cycle, that IV is ultra low. The movement has been kind of channely, and let's take a look at the term structure. You can see relatively tight. Right. I think I could do extremely well carrying a calendar, like a July-August calendar. I currently have a call spread on that I'm probably going to convert. Adam, I agree with your sentiment. That's probably a little much for this discussion. Maybe the one on the 18th. So here you have kind of a concept where in Ulta, July has only about 10 days to expiration. Right. So I don't mind owning July against some cheap August. I really don't. And this is not one that has weeklies, unfortunately. And actually, if you look at that calendar, and I'll show you what this calendar looks like. There's still some decent juice in July. We'll come back. So here's Alta. There's, $1.75 of juice on that 175 contract. I think we could meander higher. And the August is only $4.15. So that 1 month calendar, or 10 days, I collect 175. And I'm only paying $2.40 for that spread. I can tell you this. If we sit here, I'm going to do really well selling this in a couple of weeks, and we probably are going to. So in summary, understand how calendars are like straddles, understand the risk warning signs of term structure, learn to recognize the checklist for a good calendar, and look for the best structure for a trade. So I'm going to share an offer, then I'm going to show you how I might walk through another calendar spread, and then I'll take questions. So we are doing a class on July 18th from 9 a.m. to 1 p.m. Eastern Time. 4 hours. All right. You're going to master long and short calendars. We're going to learn risk control and adjustment techniques. We had a couple people ask, well, how do you do, how do you fix calendars? We'll cover that. I'm going to teach you how to use weeklies and for kind of directional calendars and income trading. And I'm also going to talk about diagonals in short and long-term directional trades. So we're going to cover a ton in this class. We'll show you some really fun ways to set up directional calendars. You should see some of the different spreads that we've done that have been really successful. And all you do is you go to optionpit.com/calendar and you sign up, and it's normally $247. We're charging $147. But if you sign up by Friday, I've reactivated the code 25_off. It is case sensitive. So it's 25_ capital O, capital F, capital F. You can take an extra $25 off. But this ends Friday. All right, it's going to be July 18th. We will do the recordings. All right, and you get access to these recordings after the class, along with everything else. I'm going to teach all that stuff. That is where the idea of control and adjustment techniques. All right, we'll also talk about earnings calendars, some really fun stuff. So I'm going to teach you about kind of Adam, one of my students, talk about setting up anchors, and that's really what I do here, what we do. Yeah, so we're going to teach you some stuff about earnings, using them as an anchor, all sorts of fun stuff. It is going to be, I can tell you, anybody who's taken these directional classes will tell you they learn a ton. And obviously, if you're an Option Pit Live subscriber, they are free. So that is one of the fun reasons why it pays to be a subscriber of Option Pit. So we have, and we do these. We do, think about this. We do 10 of these a year. We do 8, or 7 to 8 of these specialty classes, and 2 to 3 boot camps. So we do between 8 and 11 of these a year. And they're usually between $147 and $247. And a monthly subscription to Option Pit Live is only $97. You do the math. So let's look for an interesting calendar. So I'm just going to go pull up a name. We definitely saw volatility get kind of smoked today. But, why don't we, see if we can find something that has what we'll call like What do you do? What do you in Option Pit Room is weekly trades or daily trades or monthly trades? Our typical trade duration is going to be 5 to 14 days, but we do hit little home runs that will take off the next day. It's probably somewhere in between swing trading and income trading. Call it a little bit of both. We definitely have guys that like to day trade that talk about it, but I would say most of our stuff is medium term. All right. So let's look for, I'm looking at the VIX. 16 is kind of mid-vol. So with vol here, I want to find something that has really cheap volatility. And none of these really look that interesting. So I'm going to see if there's anything imploding. Humana's an earnings play. RBC, Catamaran. Catamaran might be interesting. Zoom Corp. Taiwan Semiconductors. I don't think they're a buyout. And A-Pole, no thanks. All right, so let's look at CTRX. All right, they do not have a corporate action, I believe, right? IV of 3, they must, no, that's corporate action. You wouldn't have an IV of 3 if there wasn't a corporate action. All right, so I will look at again. Let's see if we find anything interesting. And SPX itself would be kind of interesting. So as I look at a few of these names, Microsoft, I'm going to try and do an earnings anchor trade. So Goldman's way too close. Gold. All right, gold volatility. So let's take a look at gold volatility. Why not scan IV versus HB? Because I'm actually looking for IV that's actually sinking, and you really need to find, if you look for imploding historical volatility, see, they're all gains. They're not drops. And I'm actually looking for imploding volatility. So let's look at the Spider Gold Trust. All right, and we're going to look at a daily chart. And you can see the volatility. I'm going to drop. We're just going to look at the volatility. That's this red line. And it looks like we're kind of popping out of a recent low vol cycle that is a serious low vol cycle in what amounts to a very, very low volatility cycle. So this is a potentially interesting candidate. Then if I look at term structure, I'm going to look and see what I can get. You can see August 21, I can buy 13.6 volatility, 13.66. July, I can do July next week, the following week, or July 31s. All right. Let's take a look at the underlying. Really, after holding a range, had a little bit of a breakout today. But I would think this could go back to 112. Certainly 111. I don't hate this. This might be an interesting double calendar candidate, to be honest. But since I'm just covering single calendars, the way I might look at this would be at the August 111 strike. And then I would probably do, I'm going to look at the July 31s. You can see that's a relatively tight spread. So if I pull this up, I can do the 111. That's the at the money calendar with 21 days, 3 weeks in between. It only cost me 50 cents, 55 cents. All right, does 55 cents seem inexpensive for that calendar to you, considering it's a $111 stock? Yeah, I mean, this to me looks like a quintessential calendar candidate. Again, I might set this up as a double calendar because I'm not sure where it's going to go. So I might set this up at like the 112 level and maybe the 109 or the 109 and a half, or maybe the 110. So maybe I do like the 110, 112. Something along those lines, and set that up as a very simple calendar spread. If you look at the risk on this is beauty. We got 10 lot there. So let's just look at 10% movement over the next 8 weeks. And we'll just go out to July. I mean, the risk reward on this guy is relatively nice. So, just real briefly, my risk is $500. And if I wait till somewhere between, if I wait till about the 18th, 19th, or 20th, I potentially make 30% on my risk. That 150 level. That's a decent calendar. All right, guys. So what questions do you have for me? Remember, www.optionpit.com/calendar. Question is, will I be going over double calendars in the class? Yes, I will. Absolutely. All right. Any other questions? www.optionpit.com/calendar. Can I put up my checklist again? Sure. How important is open interest? It's not. Do I record this session? Yes. Straddle swaps are essentially the same thing as a calendar. There are some modest differences. But yeah, I will happily that's kind of a more nuanced trade, but if that's something that you want me to go through, one of the things about these classes is I literally build the slides the week of, and or update them the week of to make sure that they're really good. Where do you get the term structure? It should be from your brokerage firm where you can look at it. If your brokerage firm can't give you good term structures, you need a new broker. What criteria is single, double? So this is my checklist for a single calendars. What is criteria for single versus double? A double calendar is more of a strangle swap, and you're saying, well, I'm not quite sure. I think this could move around a little more. What does the LiveVol software cost? It is free if you use it for execution as I do. Does Thinkorswim have term structure? I believe they do. Not sure if it's very good. I certainly wouldn't trust it for index options, but they do for, they do. But yeah, LiveVol is free. At the money expiry works for term structure if you don't have it. That is correct. You're welcome, Cheryl. Any other questions? Does Fidelity have term structure? I believe they do. Because I believe they do, but I'm not an expert on Fidelity. And so that would be another question to ask yourself. No problem. All right, any other questions, folks? Which brokers can you use LiveVol with? They are their own broker. They're actually owned by Lightspeed now, so they're pretty good. What do you use for futures options? LiveVol X doesn't happen. I would use TD or IB. Are we doing debit or credit spreads? No, that is not the subject of this discussion. All right. Any other questions? We all getting stoked for July 18th. It's going to be awesome. I thought SIBO bought LiveVol. LiveVol Securities got bought by Lightspeed. What is the typical return for calendar spreads? I'm looking for typically about 20%. So if that was where I came. 20 to 30% is about nice on risk. So that GLD calendar had about $550 of risk. I'd like to make more than 100 up to 150, 160 bucks. How does SIBO benefit from buying LiveVol? What are they doing with it? That is its own discussion. I'm happy to talk shop about that one if you want, but that's probably more a personal discussion. But I know them very well, and I think I think SIBO's doing the right thing. The max profit on calendars. It varies by the calendar. There is no true max profit on a calendar other than the limit up. Can you close early, or do you need to wait for expiration? You can absolutely close early. I close early all the time. So that's why I'm saying when you get up to on that GLD calendar, when I'm up 140 bucks, 150 bucks, I'm probably going to close it. Cover both sides. Or what I might do is roll it back to a different expiry. I do that a lot. Rolling calendars. It's one of my favorite ways to manage a trade. Doctor. See you on the 18th. All right, guys, it is 8:01. Of course. All right, this is a pull up the curtain. In 4 hours, I've got a lot to cover, but I'm going to give you a lot. I think you're going to be very pleased. Anybody who's taken our Saturday classes will tell you they're pretty good. All right, guys. I want to thank everybody for coming. Again, go to optionpit.com/calendar. It's just you with G-Money's in it. Don't worry. So it's Andrew's going to do the first couple, and then Andrew does the first 2 hours. I do the next 2 hours. It's really an hour and 50 minutes each. All right. Well, thank you, Simon. I appreciate that. We're real and we're fantastic. You guys have a great night.